There's going to be somebody who's going to trade the IBIT options, but they're going to trade the underlying Bitcoin spot 24/7. If you can do that, you are the person that's outside the perfect arbitrage pricing model that can do different things. So this is why I continue to believe that crypto native derivatives traders are going to make more money than those who have to be in one system or the other, because you are able to live in both worlds. But if you can lean on that and trade Bitcoin throughout the weekends, through Saturday and Sunday and overnight, then you got yourself some free gamma.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today. Welcome back to another episode, and joining me today is Jeff Park, head of alpha strategies at Bitwise Investment, and renowned on crypto Twitter / financial Twitter as the guy to talk to in terms of anything related to Bitcoin and MicroStrategy options. So I'm super excited to have you on today. We're recording this we're into the second day of options that are trading are now live. We obviously had the BlackRock ETF go live yesterday. We had the rest of the ETFs go live today. So, no one I'd rather talk to just break down what we've been seeing and how it's all coming together. So, yeah, just stoked to have you on the show, Jeff.
Thanks for having me, Felix. Huge fan of On the Margin. Dare I say, one of my favorites of the Blockworks family. So super excited and privileged to be here. Thanks for having me.
Awesome. So, a couple months ago, you came across my feed because you had a pretty interesting thesis this was around the time where we started to see some headway and some traction getting going in terms of actually getting these options live on the Bitcoin ETFs. And you had this really interesting thesis that we'll get into, but I just want to open up the stage for you to basically flesh out what were some of your key expectations going into this, and then also just hearing a bit more about how those have actually come to pan out, and just digging into some of the specific expectations that you've seen versus reality.
So the TLDR on what I shared now, I think about 2 months ago, upon the news of the SEC providing approval for the Bitcoin ETF options to be listed, was that we're going to be on the verge of witnessing one of the most extraordinary upside vol event in financial history. So the key thing here is that volatility is a multidimensional measure, and some people think about volatility in a fairly rudimentary way, maybe in an academic way. They'll say it's the rolling average of standard deviations over some period of time. But as you know, and practitioners know, that's not the only way to measure volatility, right? Let's say something doesn't move for a long time, and then one day it just moves 5 standard deviation, right? The vol. I would not characterize that as a low vol asset, right? And Bitcoin's a very unique asset where it actually has pretty high rolling volatility on average, and it also has a high amount of vol, which means that the tails can be quite fat in its return history, both to the left and equally importantly to the right. So the thing that I wanted to bring to light is most folks who have been trading options will know that there is a phenomenon called the volatility skew, which is that downside protection tends to be a little bit more expensive than the symmetric contract to participate towards the upside. Meaning, humans generally want protection, and insurance costs a premium, and they're willing to pay a little bit above what the implied volatility at fair value should be. That also makes sense because most financial assets actually crash down rather than have events where they go up astronomically unless there's a specific catalyst like a merger or a drug discovery or something like that. Bitcoin is unique because it actually has what is called a volatility smile. And it
Mm.
means that the call options can be just as expensive as the put options. And that really means meltups can be just as likely as meltdowns. And there's a lot of phenomenons that can happen around this kind of volatility distribution. And historically, no financial instrument really allowed regulated market participants to express views on this particular path dependency. So many times people would have said, "Hey, Jeff, Bitcoin options have actually been around for a long time. You've had things like Deribit and Ledger and ways to trade it." And the reality is, those things are interesting, but it's not where most regulated practitioners actually would choose to express their risk. It also doesn't open the door for a lot of retail traders that are interested in accessing this particular financial instrument that makes it challenging to go offshore. And so there's a variety of reasons that I think this was a monumental event. But the key point here being that it will give investors a chance to express path dependency in a way that historically has not been possible before. And there's a specific and a thesis I've had around what that will mean for Bitcoin in the future.
I want to just characterize a little bit more the uniqueness of this skew, this smile that you're talking about. So yeah, as you mentioned, generally speaking, like people are long assets, and so the average person will likely not try to add on further leverage with calls or something like that, but they will try to have some sort of hedging of like a left tail risk. So they'll buy some puts. So that leads to if you just look at like I don't know like an index of like QQQ or something or SPY, puts are more expensive than calls generally speaking. But what you're saying here is that just due to how volatile generally speaking Bitcoin is, to the upside and to the downside, is that calls are equally priced at this additional premium. And I just want to hear a bit more about like how unique is that. Obviously, like you mentioned Deribit, which has been like an existing on chain, or not on chain, but options platform that's existed for quite a few years. There has also been like on chain options platforms that have existed as well, but they just, again, like you said, there hasn't been the regulatory clarity for big money to come in and participate there as much. So I just want to hear like, obviously we've seen that volatility smile exist on those platforms already. We've seen it exist in MicroStrategy already, but has there been examples of this outside of crypto where we've seen this sort of distribution, or is this like a idiosyncratic thing to just crypto?
Sure, great question. There is probably not a lot of assets that demonstrate this particular feature, but there are some. There are some. And actually, that world most likely lives in commodities. And so this goes back to the original question of, is Bitcoin a security or a commodity? And at some level, one of the reasons I think people fundamentally, obviously think it's a commodity is because of the particular way the market structure even exists. And so if you think about oil as a commodity, you will sometimes see volatility smiles at moments of distress and supply shocks that create very disparate hedging behavior amongst the producers as well as speculators. So I think that is a good example of the necessity of it generally being like a hard asset where the valuation framework isn't so much driven by like fundamental analysis based on value investing or cash flow based principles. It really manifests itself with assets that are most prone to the technical structure of market positioning. So the marginal buying and selling pressure is actually the first order determinant of price setting rather than having a valuation based investor coming into making a play. Um, so the reason, nonetheless, though, Bitcoin is really different than even something like oil or natural gas is because it is at its purest form code, right? So actually, it doesn't even take up space. And what you find oftentimes with oil futures and oil spot assets too is that it exhibits some kind of basis on the auxiliary costs associated with servicing it as a physical asset. So you'll see when you price the forward curve on these commodities, things like storage costs and transports play a big role in that arbitrage of where these things should be. And there are financial investors who try to capitalize upon these inefficiencies too. But crypto is really, really pure. Bitcoin doesn't really have those kinds of noise, if you will, those kind of basis. And so, in a way, that makes it even more obvious as to how to how to price that skew. There's only one reason the skew exists, and it's because of the singular price movement of the asset and no other kind of components that some investors might want to think about with harder commodities. The other thing is when you trade oil futures, those things are termed, right? So you have to think about 1 month, 3 month, 6 month type of futures contracts, which actually lives in its own forward curve. What that I think also signifies is that most commodities are not perpetual in nature, that they do in fact expire. You know that for sure with agriculture, they expire. Uh, Again, Bitcoin is super unique because it is actually perhaps the first time we've had a perpetual commodity access to financial market in a way where it is definitionally perpetual in nature. And that I think brings a lot of purity, in my opinion, in the way that a vol arbitrager can look at the specificity of the surface in ways that is not always possible, even with other commodities.
Obviously, we'll get into the potential impact of this skew, but I just want to further understand, like, when I look at when we talk about Bitcoin and we talk about supply versus like traditional commodities, if a traditional commodity like oil or I don't know copper or even gold, when price rises significantly, what you get is that miners that weren't profitable at a previous price are now profitable at that price. So then you have an increase in supply, and that mean reverts price in a way. But what's unique about Bitcoin is that due to like the difficulty adjustment, et cetera, is that when price increases, you don't see that same increase in supply. The supply is constant, and the difficulty adjustment basically keeps that constant. So what I'm trying to understand here is that okay, typically in a commodity, if we just got a huge up move and we see that volatility smile occur, it'll likely mean revert because of that dynamic where supply will come on, right? But as opposed to here in this situation, my understanding is that because of what I just talked about with Bitcoin, is that it remains constant. The supply demand dynamics remain pretty constant. Is that right?
Yeah, that's exactly right. There is almost a programmatic way to thinking about the supply creation where it's finite and known to the entire supply exercise, which also is another thing that brings ultimate purity to how people will look at this as an asset that moves based on marginal selling and buying pressure, where there's less exogenous risks that can be introduced. This is important. This is actually, I think, one of the core principles of why Bitcoin, in my opinion, is what I call a flow asset rather than a state asset, meaning state assets have a price in which it has to be consumed for some kind of utility that it brings to economic productivity. And it fits into a broader productivity calculus. Like oil has a price in which it needs to contribute to the GDP growth in the way that our systems work. But Bitcoin is a little bit more like currency in some sense of it being a flow asset where it isn't really a price that stands beyond a moment in time where people just want to transact and find some exchange of value. So if you believe that there isn't really a natural floor or a ceiling towards where Bitcoin should be anchored by some way to think about the productivity that it brings to people. I think that's a unique point that sometimes gets lost in translation because when you see short squeezes in oil and other things, it tends to revert because there is kind of a need for it to find a stabilizing price to reality. And you'll have producers act upon it. You'll have government interventions upon it. But crypto today, Bitcoin, isn't necessarily plugged in like this. And so if it gets a short squeeze and it actually goes up a lot higher than where we are today, what I mean to say is, yes, some people will have lost money along that way. And some people will have made money along that way. But it actually is a net neutral event to the system amongst the constituents where there's no then additional pressure to have it come down beyond the fact that, yes, sometimes people will say it's overvalued and they'll sell and go to cash or whatever, and those things matter. But those are more what I would call like trading patterns and cost basis calculations of where the moving averages of that weighted cost basis might be across cycle. The other thing worth mentioning is you see this incredible phenomenon where corporates today are rewarded at some level by having Bitcoin on the balance sheet, right? You mentioned MicroStrategy as one particular exaggerated example of that singular thesis and pursuit. But there are other companies that have went around this with some great halo effect. So I mentioned Tesla as one too. Tesla is one where I wouldn't say it's a Bitcoin play, but it does have some Bitcoin. And in some ways, I do think that was the moment that the broader investment management community decided they're not going to short Tesla anymore. And part of it is because you have one more, this unknown exogenous risk that actually it might melt up in a way that has nothing to do with the business of EV. Uh, and if you think about that value, it's so interesting and important for a corporate treasury to consider. And so from that perspective alone, you see people like even miners that are now choosing to actually not sell right now. So we're talking about producers, as you mentioned, commodities producers, they would go sell. It's a predictable business. Well, guess what? Marathon just came out and they printed a multi-billion-dollar paper on a convert in which they've actually said the point is to buy Bitcoin, right? They also got rewarded by having it a 0% convertible note. And so here you have producers that are actually also running along the thesis of I'm not selling it into the market based on the price movement. It's going to be a hold asset and the market's rewarding you for it. So actually that also creates another dimension where the commodities dynamics is not necessarily translated the same way for crypto and the Bitcoin economy.
Got it. Yeah, that's a great explanation. So, okay, we've characterized the fact that Bitcoin has some properties that are unique from traditional commodities that are making it so that this volatility skew is persistent in the option structure. So, I want to take that and start to look into some of the data that we've seen from the past few days. So, obviously, we've had a full day of trading yesterday on IBIT, and then we're starting to see some flows come in on the other ETFs that have launched their options now. So, I just want to get like a high level take of what are you seeing in the data in terms of who's buying these options? Or is it, as suspected, more calls and puts? What's like the put call ratio there? What contracts are people focusing on? And how is that volatility skew that we just explained coming into how you're viewing things in terms of the actual data as it comes in?
Yesterday was such an exciting day to finally see the pricing market structure come to develop in action. And there were so many things that I was fascinated by. But maybe I'll highlight a few things and touch upon some of the questions you asked around what was the most important things to take away. The first thing that was super obvious was even in that one intraday period, you saw Bitcoin spot and implied volatility have a very, very unstable correlation. So this is the other component of skew and the volatility smile that we need to incorporate at some level, which is that generally these things exist because people assume a certain spot vol correlation, right? So in other words, if the market crashes, volatility tends to go up, right? That's a known correlation for most assets. But Bitcoin yesterday had two like local peaks and troughs, and then eventually it trickled down towards the end. While Bitcoin was actually going down. So that's also weird in itself, right? If Bitcoin's going down, you expect vol to go up, but it didn't. They went down together. And as Bitcoin was going up for most of the day in a pretty steady way, it was actually one of the steadiest up climb I think I've seen in the last 10 days. Bitcoin vol was up and down and up and down, right? So the intraday correlation is actually really unstable. And that's, I think, in a lot of ways where the opportunities to trade Vega and Gamma will come in for most investors. In terms of retail or institutional interest on what found the most amount of activity, the thing that I took away was the put call ratio was extremely skewed towards calls. I think Eric Balchunas and other folks on the Bloomberg team tweeted about this as well. But it was fairly skewed to the point of maybe 4 times, 5 times call interests being higher than put interests. What's really interesting here, though, is if you actually dig in to look at that put call ratio by expiration date, you'll see a very straight linear line down of that actually exacerbating as you go out further in the term structure. So when you go out all the way to the 2027 options, that put call ratio is less than 0.1. That's saying there's a 10 times imbalance for calls versus puts. So that already tells you from day one that a lot of the positioning that people are interested is to the upside. This is important because it's actually counter to a lot of the pundits that have been talking about why Bitcoin options is actually going to reduce volatility. It's because people are going to want to come in and start hedging their downside risk. That's what options are for. So actually, Bitcoin volatility will likely go down because of the introduction of these financial derivatives that allow hedging. And I disagreed with that at some level. And yesterday was maybe a little bit of a vindication to see that is maybe not going to be the case. Now it's early. We're going to see a lot more varied participation and different types of buyers in the future. But I continue to believe that a lot of the folks are interested in finding ways to build leverage into their positioning of Bitcoin that is more capital efficient. Here's the reason. When I am at front of clients at Bitwise, and I do this every day, trying to enthuse the mission of Bitcoin adoption and why it's important for your portfolio in your 60/40 allocation, a lot of investors will say, if I just put like 1 to 3%, then I guess that's the right size. And we ask them, like, well, why would that be the right size? And what you hear often is that's the size in which if it goes to zero, it doesn't matter. And if it goes up 10x, it will be an important driver of my return overall.
Sounds like a call option.
That's literally an option.
Yeah.
That's exactly what an option is. And so what you're telling me is, okay, so these people are already thinking about allocating to an asset where it can go to zero, and they're thinking about it as a premium outlay. Well, let me tell you, if you're only going to put 3% of your notional into Bitcoin, I can guarantee you'll get much more leverage for that cash outlay if you use options. And I think many people will still continue to express their views this way because they're still very concerned about the asymmetry of Bitcoin's total return profile.
Yeah, that's a really great point because I know, like, I tweeted about this yesterday and I saw you called it out as well. Is that, like, when I just look at the options chain right now, like the furthest out expiry, like January 2027, all the activity is on the furthest out strike, like the 100 strike. So I think you're correct that there's a lot of people that are just looking at it as like, all right, if I just, put out, they're trading at like, yes, $16 right now. You put that out there and you're like, if it goes to zero, that's okay. But like, I have a pretty convex upside potential payoff here in the next few years. So people, it does seem like people are mostly going pretty big on some of those out of the money calls.
On that point, like this is not an irrational thing, by the way. So the contract that really took my attention at some level on these long dated options is that you're paying like quite little premium over a period of time where the decay is essentially going to be pretty non-existing. So I think sometimes people think that these are lottery tickets that are worthless because the chance of it going in the money is so low, and then it's basically going to decay every day, and it will decay every day. But when you go out that far out of the money and that far out in the tenor, it doesn't decay that fast. The option value is not going to change that much. And so it really is a free call option. Like, no pun intended, it's like a call option of a call option. And I do think that there are some sophisticated investors who are able to take advantage of this natural state of the funding model that supports these kinds of risk taking.
I'm curious on that point. Just looking at, I was tracking pretty closely just the implied volatility that we launched at and where it went out through the part of the day. And I was also having a look at like what is the historical implied volatilities on like Deribit and where we've been there. And I'm curious about your take. Like, we're at 65 right now on IBIT. Like, do you feel like that's low, or is that where we should be? And do you feel like that'll track pretty closely to what we see on Deribit as well? Like, what's your overall take on where implied vol has settled out here so far?
There's two questions in there I hear. One is the relative rank of the 62, 65 vol today. And then the second question is the comparison between IBIT vol and Deribit vol and where you think there might be a relationship. So on the first question, I think that there is a lot of room for vol to still go up. And it's because when you look at the volatility cone of even the last year, we're maybe about below 75 percentile, slightly above the median. The last time I checked on Deribit's vol distribution. And the max was somewhere around 85 in the past year. So there's room to grow. This isn't like MicroStrategy, for example, where we're about to hit 200 implied vol today. We're very close to it. That will be an all-time high. And I would say there, the risk is a little bit more asymmetric to the downside of it coming in. So that's point one. On the relationship between Deribit vol and IBIT vol, I think that there is something really interesting, which is if you think about Deribit, it's a crypto native exchange, right? And so you can trade those options anytime, whereas IBIT options, you can't. Those are 9:30 to 4 p.m. instruments. So That means that derivative options technically have a much longer shelf life for gamma monetization than the IBIT options will let you. So fundamentally, they shouldn't actually be treated the same way. It's almost like, let's imagine security A was Bitcoin between 9:30 and 4, and security B was Bitcoin between 4 p.m. and 9:30 a.m. And they're different beasts, right? They're different. They have their own trading pattern. Uh, and Deribit is the option that gives you A and B. IBIT gives you A. And so, what does that mean, practically speaking? It means that if you believe that Black-Scholes is based off of the implied volatility being the clearing input for a delta hedging replication portfolio, you get almost uh, half the more time to monetize that gamma with Deribit options than you will with IBIT options. And so even a few days ago, I posted this on Twitter. If you looked at the close to close vol of futures, there was a day when it looked like maybe Bitcoin moved like 30 bips. But if you measured all the intra day highs and lows throughout and actually annualize that number, it was 800% vol. So if you could trade the gamma for those hours that you couldn't with an IBIT option, then technically that's free theta. You could make money leaning onto those exposure in a way that you couldn't have before. So this is maybe a long way of saying that there are ways in which you still would imagine there should be one volatility surface for one contract. But now I'm going to say there's going to be somebody who's going to trade the IBIT options, but they're going to trade the underlying Bitcoin spot 24/7. If you can do that, you are the person that's outside the perfect arbitrage pricing model that can do different things. So this is why I continue to believe that crypto native derivatives traders are going to make more money than those who have to be in one system or the other, because you are able to live in both worlds and do things that Millennium, for example, couldn't do. And Millennium is most likely going to be the price setter for the IBIT vol surface because they're the heaviest consumers, most likely in the traditional system. But if you can lean on that and trade Bitcoin throughout the weekends, through Saturday and Sunday and overnight, then you got yourself some free gamma.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. Today's episode is brought to you by Mantra Chain. Mantra Chain's mainnet has officially launched, marking a major milestone in their journey to become the go-to platform for tokenized real-world assets. Designed as a specialized real-world asset Layer 1 blockchain, Mantra Chain paves the way for traditional financial institutions to enter the Web3 space seamlessly and securely. With a high-performance infrastructure that can handle both permissionless and permission applications, Mantra is setting the standard as the home of real-world assets. Plus, they're making waves with big partnerships like their $500 million project with MAG Group and a new collaboration with Zan Bank in the UAE. Mantra Chain is all about building a compliant, scalable future for asset tokenization. Ready to explore the future of asset tokenization? Visit mantrachain.io to learn more and see how they're shaping the finance of tomorrow. Okay, so let me see if I have this straight here. So basically, because, when I compare what we're talking about to say like, Bitcoin perpetuals, like it's unlimited data. So you don't need to really worry about the difference between like whether spot is trading versus close or something like that versus like on Deribit, the options should be probably priced differently than the IBIT options because the theta is longer because it's open for trading all the time versus IBIT is only open for what is it, 8 hours a day or whatever. Therefore, if there's higher theta, you have more time for the option to end up, basically in the money, which means I would imagine like a higher probability of expiring in the money, which therefore should lead to higher vega and delta. Do I have that right?
Yeah, that's roughly right. Meaning, the TLDR here is those vol surfaces should not be the same. They should not be the same vol. If it's the same vol, then you should absolutely go along the deribit vol because it shouldn't be. I think this is an incredible phenomenon where this moment in time for Bitcoin ETF options to exist it's really historic because to me it's ultimately Wall Street's answer to if you can't beat them, join them. It's that moment. Um, Goldman, you might have seen, is now spinning out their digital assets team. Who knows what that's all going to be about? I think it has to do more with the distributed ledger technology instead of trading. But if you think about kind of the interest in TradFi, this really is a seismic shift that signals Bitcoin's not anymore this outside system asset. It's a cornerstone of like our modern markets, and it's now blending the line between traditional finance and crypto. And so for someone like me who approached crypto with a financialization interest as well as a technological interest, it's giving us a new era of legitimacy, levered legitimacy, if you will, into the future construct of money and the money velocity.
Okay, cool. So I feel like we've done a pretty good job of like contextualizing the landscape that is existing now. And I want to spend a little bit of time of understanding how our options dealer is going to be dealing with this landscape that we just showed. So obviously, we have way more calls and puts, a lot more activity on out of the money than in the money, especially long dated ones. We have this volatility smile they talked about. So I want to just spend some time trying to unpack. This is what gets really interesting these days is so much of spot price action gets driven by what is happening from the options dealers, i.e. the market makers as another term. So I want to start to unpack here, step by step, those different, contextualizations that we just went through. What does that imply for how options dealers are, like, what's their activity looking like within that context? And what is the potential implications on spot price because of those, hedging dynamics?
The most important thing is to understand how dealers are positioned towards whether they're naturally short or long these options. And you will never have perfect clarity into their exact positioning as to whether they're longs or shorts of the open interest, but you can generally tell. And the reason is most of the times with upside, as is seen in almost every asset, people buy long vol to speculate. You don't see the dealers necessarily doing that, especially super long dated, unless it's coming from the back of like a principal protected buffered note type of transaction, the structured products business, which I think will arrive, but it hasn't yet. So knowing that it hasn't arrived yet, we can almost certainly know all the people that bought those IBIT long dated out of the money leaps are retail or institutional investors who want to take that directional risk. So with that clarity, now we know that there are certain open interests where there's going to be what is called a gamma squeeze. The gamma squeeze is a very, I think now well-known phenomenon. Once upon a time, it was a little bit of an esoteric corner of derivatives market, but I think GameStop put it on the map for everybody. But I'll just give the quick 30-second overview. The concept of a squeeze, a gamma squeeze, is that the dealers who are naturally short those vol exposure, to hedge it will actually end up exacerbating the price movement as a result of their hedging portfolio. So if you're short calls, right, you have to buy stock to hedge. As you go up, you get shorter and shorter delta, so you got to buy more to keep hedging. Well, now you're buying into strength. That's called a gamma squeeze because you're literally the person that is contributing to furthering the movement of the price that is recursively now making you buy more. That's not the case when gamma is long by dealers. When gamma is long by dealers, their hedging transaction is the reverse, right? So if I'm long a call as the dealer and I'm short the stock and the stock is going up, so my delta is increasing, then my hedging portfolio is to sell the stock. So when dealers are long gamma, it's actually creating mean reversion. When dealers are short gamma, it creates momentum. And so This is the thing that I think a lot of people are aware of. There's not enough today to see exactly how large those gamma pins will become over time, but I suspect that a lot of the interest will continue to build there. You already saw that happen on day one of this going live, which actually blew my mind. I didn't think it would be that fast. I thought we would start seeing it
Same.
over a
Yeah.
week or two, but this was screaming to your face that this is what's going to continue to happen for a while. Uh, and so what this ultimately means is that the gamma squeezes are more likely going to be observable by all market participants. And so they're going to be able to think about those types of air pockets. Now we have to talk about Bitcoin and the unique nature of why this is even more of a phenomenon for Bitcoin, which is, we just talked about this, the skew. For Bitcoin, because it can melt up just as much as it melts down, when it goes up a lot in price, the vol actually goes up. You saw that with MicroStrategy. The fact that MicroStrategy is higher and now the implied vol is the highest it's ever been, while it's had a consecutive run that's now over 50% this week alone, shows you the incredible correlation that is not typical of most assets in the securities world. And so if vol goes higher, the input of that to Black-Scholes means the delta also goes higher. So there's this hidden second order Greek, and that's called Havana, which is that mark to market, you won't see it throughout the day. But once you reprice the options, your delta will have jumped because your vol moved with you. And it was not a static number you assumed at the beginning of the day. So it means you're underhedged, and now you have to overhedge the next day. And this is actually a pretty recursive thing, and why I call it like adding fuel to the rocket that was already going to take off at an extraordinary level. And this is the most powerful thing, in my opinion, that will accelerate the discovery of Bitcoin's price in the future, where folks would complain that some of this really just feels like financialization that is creating paper flows and paper money and synthetic things that is diluting Bitcoin. And that's absolutely further from the truth. All it's doing is it's accelerating the velocity of Bitcoin's price discovery by being able to use leverage in a way that the system has not seen it before.
That's a really great explanation, and it sets up my question I have here, which is, what would I say is one of the main points of perhaps debate around the potential for this reflexivity to occur is, you mentioned GameStop earlier, which is why everybody knows what a gamma squeeze is now, is because that's what happened there. And as we know, the reason that reflexivity mostly ends is the ability for the company to actually issue equity and basically stop that
Right.
train from continuing. So now we're in this world that you imply, and we've talked about it at the beginning of the show, is because of the properties of Bitcoin. um, they can't issue more Bitcoin. They can't issue more equity Bitcoin or anything, and stop that gamma squeeze from occurring. And that's why the volatility smile is so persistent. So my main question, and perhaps debate around this is, yes, we cannot create more Bitcoin, but potentially we can perhaps create more Bitcoin derivatives as a means to for dealers to actually hedge that. So, I've seen like a couple points of, you mentioned that dealers would have to buy the shares to delta hedge, but there could be the debate of, I've seen a couple points where perhaps they could actually, just buy the futures contract or something like that, or some sort of former derivative, so to expand the derivative of this hedging ability. Um, so even though they cannot actually buy, we cannot issue more Bitcoin, is there potential for this not to occur because we can issue more derivatives of Bitcoin, if that makes sense?
Mhm. So I think what you're alluding to is that the nature of leverage allows you to synthetically create more risk and exposure that isn't one-to-one collateralized, right? This is why it is accelerating, in my opinion, the velocity rather than actually the creation of the state money, because there is an offsetting side to every one of these financial transactions. Whenever you create a derivative where you're long, there is a short against it. It's not just one direction. Can there be momentary glitches in ways where clearing can be an issue, where the financial infrastructure and its plumbing may not properly account for some of these notionals? Rare, but it's possible. Like, this is actually a risk that I think we generally have in the financial system, which is why we have the OCC. at the center and having them needed to sign off on the launch of these ETF options. It is still possible today, even though you're not allowed to short stocks naked, that it could happen, right? Reg show was put in place, so you're not permitted to do it. It's illegal, but it's not doesn't mean that it doesn't happen, right? Sometimes it could happen. Um, that being said, for Bitcoin ETFs, it's been very clean. I have not seen actually any real material issues over the last 6 months in the ways that you would have worries about there being unaccounted inventory by the market makers. There's a lot of flexibility with the APs in the way that they deal with creation and redemptions to maybe live in a little bit of this gray area with a lack of clearing, but they generally sort that out in a matter of days. And they're not in the business, by the way, of taking those kinds of risk on balance sheet either. And they're not motivated to do that. So, APs, for example, are not really allowed to short naked. That's literally why they're there, to do the creates and redeems, to avoid that types of outcomes. They'll create the unit. So that's what I think is important to note. The other thing too is these derivatives are, as a construct, pretty useful for people that want to create structured payoffs that I think is additive for the crypto community in general. If you think about how Bitcoin has different price targets throughout the years in which they speculate over 2027 or 2028, options actually give you a chance to like create payoffs that are more tailor-made for those things than like a linear bet. So it's actually not just synthetic in creating leverage the way futures does. Like futures is one for one, right? Options actually isn't one for one. You could create custom payoffs where you have spreads and different ways that is a little bit more tailor-made for the kind of risk you want to express. And I think in general, that's a net positive for any investor.
Yeah, that's what I'm super excited for is, obviously everybody, the retail gets excited to just buy outright leap calls and just, send them to Valhalla. But, you can do things like you talk about, like, risk reversals and more complex payoffs where you can really fine tune the leverage that you can enjoy. And, that's why, like, I personally am so much more excited about options than, something like the perpetuals market that we're so used to. And on that point, I just want to hear a bit more about what you think is how it's going to change market structure, because for those that aren't deep in the perpetual world for crypto, like we've been living in this world where it's dominant derivative. Like obviously there is deribit and all of that, but like short term price action of crypto has been very, very heavily skewed by perps action, how much open interest we see there, what are the funding rates, et cetera. So I'm just curious, like, what do you think is going to happen from here on out to market structure as we start to introduce, broad based, IBIT options? Do you feel like the short term market structure is going to be more weighted by options from here on out versus perps, or do you feel like they're still going to be sort of even, or still mostly perps?
I think the number one thing is that because this is somewhat historic in the ways we have a lot of different issuers trading the same underlying, uh, you're going to have a lot of volatility surfaces for the same commodity that isn't really seen elsewhere. We don't have, for instance, like 12 gold ETFs that are traded and have their own vol surfaces. Um, so, at a high level, I actually do think that there is going to be a lot of options trading that will capitalize upon these types of inefficiencies between the vol surfaces. For instance, there's no reason, right? Bitwise's ETF vol surface should look very different from BlackRock's and Grayscale's. But the reality is it does today, at least. Bitcoin ETF options for Bitwise went live today. And I've been watching it very carefully to see where the different trading is happening. And you can see that it's not perfectly efficient. Now we're early and we still need more adoption across the curve. But I don't think today is representative of what we're going to see in the future, which is that there's going to be a lot of smart people that are interested then in arbitraging this. And when they do, it will create additional flow. It will create additional volume. This is why today, MicroStrategy actually is the number one traded stock ever in the world. It surpassed NVIDIA today, and it surpassed Tesla. Why is that? It's because there is so much option trading and the hedging activities around it. And so the number one thing that I can be assured of is that these kinds of volatility arbitrage opportunities will ultimately accelerate in creating more flows. And we're going to see continued trading volume as a result of it. Whether that translates into creations or redemptions, those are dependent upon net events. But I do think we can expect the trading numbers to go much higher than we've seen for other regular spot based exchanges.
Just as we wrap up here, I just want to try to provide like maybe a toolkit for listeners to be able to try to track and understand what's going on or not. So a little bit early in the show we talked about this idea of potential gamma squeeze happening versus dealers trying to like pin gamma. So I just want to hear a little bit more about, like, obviously we've contextualized that it's a very call heavy landscape versus puts. And so obviously because you know longs are buying a lot of calls, that means dealers are going to have to be selling a lot of calls to those buyers, which means that likely they're going to be short gamma at the stage, which means they're going to have to buy some sort of long exposure to spots. So within that context, like, where do you feel like we are as it stands? You mentioned that yesterday that you started to see some ideas, some flare ups of potential gamma squeeze. But how could somebody just track this and get a good idea of what's going on and just keep an eye on the landscape overall?
Yeah, the open interests are public information, and so you can pull them up by contract, by strike, and by expiry. And the key is, I think, you have to do some work in aggregating the pin risk based on the actual Bitcoin spot. You already know that all the ETFs are debased differently on the size as to the representation of the Bitcoin price in itself, and so there's some like groundwork that needs to be done on just streamlining the data, so we're all looking at it based on Bitcoin as a reference rate, right? Not as like the ETF's price. But I think once you do that, you'll start to see where the stress points are developing, and at least this moment in time, uh, there isn't enough of structured vol selling activities to anticipate there would be any reverse direction. I don't think that will always be the case. You saw Grayscale filed for a Bitcoin covered call ETF. We have to think about when that goes live and the size that it reaches, that they will then actively be a participant in call selling, which then will give dealers the chance to be long gamma. And so that will then offset some of the inventory risk they had otherwise. So there will be dynamic developments to the kinds of flows to expect. But at this particular moment in time, I think it's pretty one-sided and it's pretty skewed. This is actually part of why I think ultimately the approval that was granted by the CFTC and OCC restricted position limits to be 25K per contract for IBIT's options, right? Based on its market cap and trading volume, it should have been much higher than that. It should have actually been at least 10 times that, maybe upwards to 400,000, not
Yeah.
24.
Sorry, that confused me a little bit. So like the open interest cannot be higher than 25,000 on each contract.
Yeah.
What is it normally like? What do you think would be like a normal amount for something like this?
I think it could be as high as 10% in the limits of what is doable. The reason why they're restricting this, by the way, is because when you exercise options, you need to find the locate for assignability, and you can't overwhelm the locate in ways where it creates physical delivery type issues. So there is some sense to not wanting to create so much open interest, the chance that it creates those kinds of friction. But with 25,000, that is less than 0.7% of the shares outstanding of IBIT max, right? I mean, that's tiny. That's never going to have an issue. So you can imagine there's going to be some room there to actually build into it. The ultimate thing that I feel everyone is aware of, both at the institutional level when they look at things like MicroStrategy and the retail level when they have followed their experience of the GameStop, is that truly the financial system in some ways it's broken. The margining model is actually broken. We didn't get to talk about it at length, Felix, but there is a very real rational calculus as to why the funding model supports long vol, but it cannot possibly support short vol. And the struggle that maintenance margin requirements and methodologies will have against that with very volatile assets. Margining is broken in some sense. I've known it since 2008 when I started my career at Morgan Stanley. Now everybody knows about it. And now we all share the playbook as to the things we need to look out for. And so the thing that I was chatting with one of my friends earlier today is that based risk, the way that crypto talks about based, is the new risk based. I actually think there is such rationality in why people are buying long dated calls that are bought for 15 cents that expire 2 years later because it never decays. And you get the chance to own risk that's capital efficient, it's reciprocal. And in fact, it is the correct risk to take. That based risk is actually the right one. And so I come away thinking that um, crypto is living in that moment in time where hopefully this all then leads to the discovery of new prime brokerage models. I was actually at not Solana, Multicoin's Investor Day yesterday, where one of the portfolio companies, Drift, had imagined what a true prime brokerage that can do real-time permissioning across assets could look like. I think that crypto's long-term viability and future will be compounded by the discovery of these types of financial primitives as well.
Totally. Yeah, I really like that point. And, even it ties back to what we talked to at the very beginning of the show, which is just like, how do you measure risk, right? And, like traditional risk models, it's just like, yeah, you just take like the expected, standard deviation or whatever. But if something just like explodes randomly, like, and then that assumes, like a normal distribution underlying it too. And it's like, is it even like normally distributed? And so
Yeah,
I really love that point. And then you get to the question of like, should we really be measuring returns in like a Sharpe ratio basis? Or like you say, should it just be like based risk taking?
that's right. If you look at your disclosures on your brokerage accounts as to how they provide margin and Reg T, you'll see that implied volatility is not even an input. They actually will say, all right, if it is like this much out of the money, then maybe it's less risk, so you have to post less collateral. And if it's more at the money, then it's more risky, so you need to post more collateral. But actually, the relative frame of reference for that moneyness really should take volatility as an input. It matters if I'm actually looking at that moneyness for a treasury bond or Nvidia. 15% out of the money for those two assets don't mean the same thing. And so that's already, in my opinion, one of the most critical issues. The second thing is the margin models don't take expiry and duration into account. So you could literally bring the same option that has a 2-year expiry and a 2-month expiry, and the funding charge is essentially the same in the ways that most retail brokerages will be charged for. Uh, that's really, I mean, I think my son will eventually figure that doesn't make sense in a couple of years. So this is it. This is the base risk world that we live in.
I love it. I love it. That's a great way to end it. Jeff, really enjoyed having you on the show. Learned a few things there. That was really fascinating. I think people will really enjoy the options deep dive. So thanks for joining.
Yeah, happy to be here. Let's revisit this in a time where the landscape will look completely different, and I'd love to jam about what we're seeing then as well.
Yeah, exactly. And just so that we're all clear on where things are today, I just looked, the put call ratio is at 0.24. So we'll see where we're at in a few months, and maybe we can revisit then and see if those covered call ETFs start to affect things.
One more thing that I plug in for anyone who's listening and they are sophisticated, passionate, professional retail traders. I go back to re-urging the point to look across the volatility surfaces of all these issuers. I do think this is a rare moment in time before there's a lot of institutional trading activity where if you are smart, capable, you can find more efficient arbitrage opportunities and should spend time to make sure you're getting best price, best execution based on a little bit of research. And I would urge folks to look at all the ETF issuers across the Bitcoin complex outside of BlackRock's for that particular reason if you're a retail investor.
I love it. Well said. And you won't say it, but I will. But there is obviously the Bitwise ETF. So there you go.
Thank you. Thank you.
All right. Thanks, Jeff. There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.